And that is one thing that Trump has proposed. He said this is how he would pay for the reduction or maybe the complete elimination of individual income taxes. Both presidential candidates have made several tax policy proposals throughout their campaign. Today, we're going to go through every single one of Trump's tax proposals, look at who it would impact and what that impact would be. Starting with the first proposal to make the Trump tax cuts permanent. So back in 2017, during Trump's first term, he passed the Tax Cut and Jobs Act. Now in there were some provisions that were permanent and some that were just temporary, set to expire at the end of 2025. For those set to expire, Trump is proposing that those get extended permanently. So let's walk through what those are. First and foremost, the standard deduction. The Tax Cut and Jobs Act doubled the standard deduction and got rid of the personal exemption, which was a $4,000 deduction for you, your spouse, and your dependents. So pre-2018, you had a smaller standard deduction, but you also had a personal exemption. So here's where we're at today with the standard deduction and no personal exemption. Here's what it would look like in 2026 if this would not get extended. So the standard deduction would get cut in half and the personal exemption would come back, assuming you're under the income threshold, which I think was over 400,000 roughly. Now, these would obviously get inflated, but it would still be a slight decrease in deductions for most people from where we're at today. Obviously, very much dependent on the household, but just trying to give a rough idea for what this would look like. So Trump is proposing we just keep the standard deduction where it's at and get rid of the personal exemption permanently, which I would not be opposed to. I think it's just simpler to have just the standard deduction. Second, and even more importantly, is the changes to the tax brackets. So these are the tax brackets that we have today. And here are the old 2017 tax brackets that we'll revert back to in 2026 if this does not get extended. The income ranges will get updated for inflation, but the rates themselves will go up by about 3 to 4% for most people. So Trump is proposing just keeping the existing tax rates in place permanently. Another temporary provision that the Tax Cut and Jobs Act put in place was an increase to the child tax credit. So pre-2018, it was $1,000 per year per child. The Tax Cut and Jobs Act doubled it, making it $2,000, which is where it's been at ever since, with the exception of 2021 with the American Rescue Plan. So this is set to expire at the end of 2025, after which the child tax credit would go back to $1,000 per year per child. Now, I believe J.D. Vance has proposed increasing that even further, and Trump said that he'd be open to that idea. So regardless, Trump is proposing that we keep the higher child tax credit in place permanently. Another provision that is set to expire at the end of 2025, which has actually been getting a lot of attention lately, is the state and local tax deduction. So if you itemize your deductions, you can take a deduction for state and local income taxes paid, real estate taxes, and personal property taxes. This has historically been a bigger deduction for higher earners or those in states with higher income taxes or higher property taxes. Well, the Tax Cut and Jobs Act capped this at $10,000 per year. Before that, there was no cap on this. Between the cap on this and the increased standard deduction, that drastically reduced the number of people who itemized deductions from about 68% per year, taking the standard deduction in 2017 to about 90% today. Now, this is one area of the Tax Cut and Jobs Act that Trump would not want to extend. Let's listen.
I will cut taxes for families, small businesses, and workers, including restoring the SALT deduction, saving thousands of dollars for residents of New York, Pennsylvania, New Jersey, and other high-cost states.
As I mentioned, this was a deduction primarily for higher income households. As you can see here, the majority of people that took this deduction pre-2018 had an annual household income over $200,000. So while Trump wants to extend those temporary Tax Cut and Jobs Act provisions, it sounds like this would be one area that he would want to carve out, thereby allowing people to take a greater deduction beyond the current $10,000 cap. The Qualified Business Income Deduction is also another deduction set to expire at the end of 2025. So this is a deduction for small business owners that allows them to take up to a 20% deduction on qualified business income. So these are people with sole proprietorships, partnerships, S corps, and there is an income threshold on this. So like once you get over roughly 400,000, that deduction starts to phase out. So it really is geared more towards small business owners. And like I said, this is set to expire at the end of 2025, but Trump is proposing that this deduction gets made permanent. Another deduction that applies to business owners and some real estate investors is bonus depreciation. This is a provision that allows you to deduct the entire cost of a business vehicle, machinery, even some personal property for rental real estate in a single year. Typically, you have to deduct or depreciate the cost of that item over several years. What this allows you to do is to accelerate the depreciation, allowing you to take a bigger deduction in a single year, which is actually very useful for tax planning purposes because you can kind of time that purchase in higher income years. Now, the percentage that you could accelerate has varied from year to year. all the way back to when this was first introduced, I think 2002. But in the Tax Cut and Jobs Act, it was set that bonus depreciation would be 100% from 2018 to 2022. And then from there on out, it would decrease by 20% every year until it got to 0% in 2027. So right now it's 2024 and bonus depreciation is at 60%. Now, I haven't heard Trump talk about this specifically in any campaign speeches, but it is worth noting that earlier this year, there was a bill in Congress that proposed bringing back 100% bonus depreciation permanently. It passed the House. It did not pass the Senate. So we'll see on that one. The last component of the Tax Cut and Jobs Act that Trump is proposing permanency is the estate tax exemption. So back in 2017, the estate tax exemption was $5.5 million per person, or $11 million if you're married. Meaning if you left your kids an inheritance under that, they would not pay any estate taxes on it. Anything over that, they'd pay a 40% estate tax. The Tax Cut and Jobs Act doubled that amount, and it gets adjusted for inflation every year. So right now, it's $13.6 million per person, or $27.2 for a married couple. This doubling of the exemption is set to expire at the end of 2025. Trump is proposing that exemption amount remain permanent. That's everything relating to the extension of the Tax Cut and Jobs Act, but Trump has also made several other proposals this year that I want to go through, starting with no tax on tips. Now, I did a whole video on this. You can go check it out. I have my thoughts and some insights there. On those same lines, he's also proposed no tax on overtime pay. Let's check it out.
As part of our additional tax cuts, we will end all taxes on overtime. You know what that means? The people who work overtime are among the hardest working citizens in our country. And for too long, no one in Washington has been looking out for them. It's time for the working man and woman to finally catch a break, and that's what we're doing because this is a good one.
So this proposal and the no tax on tips is really geared towards hourly workers. I do think that it would be a bit complicated from a payroll perspective, but that's just kind of become the nature of taxes. Simplicity is not really at the forefront these days. He's also made another proposal that would impact senior citizens. Let's listen.
We have so many ways of making money in this country. We're not going to affect our Social Security. We're not changing it. And I proved that over 4 years. And we're going to do it. It's very unfair to people. They spend their life and they're great citizens and they pay in. We're not going to charge tax to Social Security, the seniors. We're not going to do it.
So I was really curious how many people this would impact and what the dollar impact would be for the average person. So I crunched some numbers here. Currently, we have about 67 million people collecting Social Security. About 80% of those are retirees. The other 20% are people on Social Security disability. So that's about 53.6 million people collecting Social Security retirement benefits. According to the Social Security Administration, about 40% of those people pay federal income taxes on those benefits. The remaining 60% are below the income threshold. So you have about 21.4 million people who this would impact. If you're over the income threshold, 85% of your Social Security benefits are taxable. For those people, I looked at the average annual benefits, which for 2024 was $22,322 per person or $44,644 per couple. So 85% of that is currently taxable. Let's assume an effective federal tax rate of 20%. I know it varies wildly depending on other sources of income, but let's just use that for this example. That would be an average annual tax savings of about $3,800 per year for a single person, or $316 per month, or $7,600 per year for a married couple, or $632 per month. So it's not unsubstantial. That could cover a good chunk of utilities and maybe even a nice pair of Velcro shoes. On a corporate level, Trump has said that he would like to get the corporate tax rate down from 21% to 15%. Prior to 2018, the top corporate tax rate was 35%. The Tax Cut and Jobs Act knocked that down to a flat 21%. Now, there's a debate on the actual impact of lowering corporate taxes. That's for a separate time, but just know that this only applies to C Corp. So if you have a sole proprietorship, a partnership, or an S Corp, this does not apply to you. Finally, the last one we need to talk about, and it is a big one, tariffs. Trump is a big tariff guy. He has been since 2016. And as a reminder, tariffs are a tax on imports. So what he is proposing is raising current tariffs on China to 60% and imposing a universal tariff on all US imports of 10%. Now, tariffs are tricky because historically, it's been very difficult to achieve the intended outcomes without some unintended consequences. There are two primary outcomes pursued when it comes to implementing tariffs. Number one is revenue generation. So you place a tax on the imports, and that's an additional revenue stream for the country, maybe allowing you to even reduce individual corporate income taxes. And that is one thing that Trump has proposed. He said this is how he would pay for the reduction or maybe the complete elimination of individual income taxes. I'm going to come back to that. So revenue generation is one goal. Another goal of tariffs may be to bring back manufacturing domestically. So if you place a tax on imports, if you make imports more expensive, you disincentivize importing and you incentivize production here, which is another thing that Trump has talked about. The difficulty here is that these two goals are in opposition to one another. So if you accomplish one, you can't really effectively accomplish the other. So for example, let's say that you implement a tariff with the goal of raising revenue, and let's say it's successful at raising revenue. Well, that means that imports are still happening and you have not shifted to domestic production. On the other hand, if a tariff successfully brings domestic production back here, then that means imports have slowed down, and that means that the tariff on those imports is not a great revenue generating measure. It's really tricky, and we've really never been able to get this right. You look back as far as the late 1700s, and it's always been a struggle. You have retaliatory tariffs that come into play from other countries. You have corruption and bribery in specific industries. And then there's the consequence of the cost of the tariff being passed on to the consumer in the form of higher prices, which sort of turns into a regressive tax because it's a tax on imported goods, which tend to be used more by lower income households since imported goods are cheaper. So you have that to deal with as well. The Smoot-Hawley Tariff Act of 1930 was disastrous for the Great Depression and just made matters worse. So historically, it's just been very difficult to achieve the intended outcomes without unintended consequences. And you might think, well, I'll pay a little higher for the cost of goods if it means no income tax. Well, let's actually take a look at that. The individual income tax revenue for the US is about $2.18 trillion. Imports are about $3.8 trillion. So meaning you'd have to charge a 57% tariff on all imports to completely replace the individual income tax. And that assumes zero change to imports, which historically has not been the case. Typically, as tariffs increase, imports decrease. Yeah, so I'm not sure that's a viable solution for replacing the individual income tax. I think what we need to do is really get our expenses under control. But at this point, it's kind of looking like a pipe dream. All right, I think that's everything. Just one very important thing to note is a lot can change between when a campaign promise is made and when it gets signed into law, if ever. A split Congress makes this even more unpredictable. I remember back in 2017 when the Tax Cut and Jobs Act was going through Congress. I was actually working for a Big Four accounting firm, and there was so much debate on what would be included, what would get removed, and there was just a lot of changes throughout that time. So there's still so much up in the air. What we do know is what the tax law is for 2024 and 2025, so we can at least do some tax planning around that time frame. Thanks for watching. Hope you found this helpful. Subscribe, like, share, and I'll see you next time.